If you've ever thought about retiring or leaving your job, most people are going to tell you to roll your 401k into an IRA. Now that sounds smart, right? More control, more options, but doing that too soon, it could cost you well over $30,000 in penalties. And you're not going to realize it until it's too late. It's all because of a little known rule. I've seen this little rule save clients massive amounts of money. I'll show you exactly how this special rule works, how to know if you qualify, and how to avoid one of the most expensive rollover mistakes you can make. Let's start with what everyone tells you to do when you leave a job. They'll say, just roll your 401k into an IRA. You'll get more investment options, yes. You get consolidated, yes. You gain control. These are all great reasons. Here's what no one is telling you. When you roll that 401k into an IRA, especially if you're getting close to retirement, you could be giving up a key early access loophole. It's called the Rule of 55, and losing it could cost you tens of thousands of dollars in penalties. The Rule of 55 says this: if you leave your job in the year you turn 55, or up to age 59 and a half, you can start withdrawing from that employer's 401k plan without the usual 10% early withdrawal penalty. That's a surtax that no one can get around. Now, a lot of advisors get this one wrong by telling their clients, you must be age 55. Well, that's simply not true. The rule is age 55 in the year you separate from service. Let's say, for example, that your birthday is in December. Well, you could retire as early as January. This is not an option if your money is in a traditional IRA. And that's where so many people go wrong. The Rule of 55, it only works for employer-sponsored plans, not things like IRAs, simple IRAs, or even SEP accounts. Now, another area that needs to be addressed, it's old 401k plans. And many workers, they tend to have more than one employer throughout their life. So it stands to reason they're going to have multiple 401k plans that could be scattered about. The age 55 exception, by the way, it only applies to those assets that you have in a plan where separation from service happens in the year you reach age 55 or later. It's not an option if you move to a new employer and leave your former 401k. You need to move the old plan assets to your new employer's plan or to that employer where you're planning to retire from. We refer to this as a consolidation. And regardless of your desire to retire early, consolidating your old 401k plans is a great idea. Now, the rule is golden for early retirees or people switching careers or anyone who may need to access their money before age 59 and a half. If you fall into this category, skip the rollover to an IRA. Take it from a 33-year veteran. You want to be careful when it comes to rollovers. They're not something that can be undone. Now, here's where the numbers get painful. Let's say you retire at 55 and you have a 401k balance of, say, $1.5 million. You plan to withdraw then when you reach that 55 mark, say 5% per year. And that's going to start your early retirement. Well, that withdrawal off of $1.5 million balance is going to be about $75,000 per year. You're going to be doing that until you're 59 and a half years old. So that's 4.5 years of withdrawals, or about $337,000 total. If that money is sitting in your old 401k and you qualify under the Rule of 55, there's no 10% penalty. You just pay the regular income tax, which you're going to pay either way. But if you rolled that account into an IRA, following the typical financial advisor's advice, even with good intentions, you lose the Rule of 55 protection. Now, that same $337,500 withdrawal over those 4.5 years, it's going to get hit with that 10% early penalty. That early withdrawal penalty is going to cost you almost $34,000. It's gone. Now, I've seen cases where penalties reached well beyond our example of $33,750, simply because the person moved money into the wrong account too soon. But a lot of financial professionals, they don't talk about this because they don't manage 401ks, which means they might not be aware of this loophole. Also keep in mind, it is not to be confused with Section 72T or 72Q of the Internal Revenue Code. That section of the code refers to substantially equal periodic payments, or SEPP. Section 72T deals specifically with early withdrawals, and yes, they avoid the 10% penalty. But there is a caveat. Once you start under 72T, those systematic withdrawals, they must continue for no less than 5 years or until you reach 59 and a half, whichever is longer. The rule of 55 is not the same as 72T. It's much better. You can start or stop the withdrawals at your discretion. Another reason advisors want you to transfer your 401k to an IRA, they get paid when the assets are in IRAs. So of course, they're going to be biased. Now, I'll tell you, strategy matters much more than structure. And if you're between those ages, if you happen to be there already, the structure matters a lot. This isn't about questioning everyone's motives. It's about you asking the right questions before making this move. If you're leaving a job and you're 55 or older, don't automatically roll over your 401k. Ask yourself, and your advisor for that matter, will I need to access this money before 59 and a half years old? If your answer is yes, or even maybe, leave that 401k alone until you've mapped out a withdrawal strategy. That means working with a competent advisor, someone who's not biased. Talk to someone who understands retirement tax planning, not just portfolio management. It's just more strategic than that. You can always roll it into an IRA later, but you can never undo the rollover. It's game over. The rule of 55 is gone forever. It's not one of these do-overs like we used to get when we were kids. This isn't some obscure technicality either. It's a decision that could cost you thousands, even $33,750 as I illustrated, or a lot more. And it happens in just a few years. The rule of 55, it exists for a reason. Don't let good intentions or bad advice cause you to trip. Because when you retire early, every dollar that you keep is one less you have to earn. Here's a little bonus. If you happen to be employed by your state or a federal agency, or you're a public employee, you might be able to take income without that 10% penalty as early as age 50. Now, this would include people like police officers, firefighters, and even military, to name a few. And if you want more real-world, zero-fluff financial wisdom like this, subscribe to We're Talking Money. We're not just talking theory. We're talking about your life, your wealth, and your future.